What is up, everybody? Welcome back to the channel. Today I wanted to go over what the news of the day, the week, and the past month have been, and that is the Russian invasion into the Ukraine. I'm going to share with you a bit of a summary of what the current Russia and Ukraine tensions are, what the current situation looks like now, how it may impact the stock market, and what I think you should do with your investment portfolio going forward. But before I begin, guys, if you get any value or enjoyment out of this video at all, please smash that like button down below. Really helps me out with YouTube's kind of weird, hard to predict algorithm. Would really greatly appreciate it. Now onto the video. Even though the history of Russia and the Ukraine can go back decades and even centuries, the current situation can mostly be tied to the Ukraine being somewhat interested in joining NATO. Joining NATO would allow the Ukraine to gain security and stability with Western countries, which is frankly needed when you share a border with Vladimir Putin. Now, Putin and Russia do not want the Ukraine to join NATO, and he's willing to go to war because of it. Putin and Russia do not want the Ukraine to join NATO because that would put a NATO country right on their western border, as well as allow the Ukraine to create stronger relationships with Western allies. You see, Putin still sees the Ukraine as a region and a country created by Russia and the former USSR, the Soviet Union. And at the very least, he believes they should be strong allies and a united front against the West. Even though this conflict has clearly gotten hotter and more tense the last few weeks, Russia and the Ukraine have actually been fighting a proxy war against each other for quite some time. Soon after Russia's annexation of the Crimea region in 2014, pro-Russian rebel groups gained control over two separatist regions in the eastern Ukraine. These are the regions of Donetsk and Luhansk. So as of right now, Russia currently has over 100,000 troops sitting idly by at the Russia-Ukraine border. And Putin has started to invade these two separatist regions. These regions have been immediately recognized by Putin and Russia as independent and sovereign, since they are currently still controlled by pro-Russian rebel groups. Whether or not Putin is done pushing, or if he will push all the way to Kiev, the capital of Ukraine, has yet to be seen. But this looming and ongoing threat of war has clearly put a lot of uncertainty into the stock market, as well as in the price of oil and gas. So how is this going to affect the world economy? So first, let's talk about Russia and their oil supply and who they supply their oil to. Russia produces a ton of oil and gas. According to the Wall Street Journal, Russia accounts for about 10 to 12% of the global oil and gas trade. About 60% of this supply goes to European countries, with another 30% going towards China. So even though the United States isn't dependent on Russian foreign oil, a lot of the rest of the world is. With all of this dependency on Russian oil, it's very easy to see how a potential military conflict in the Ukraine could put undue pressure on the global oil and gas supply and affect economies of much of the developed world, especially in the already tight global oil supply market. A sharp decline in the supply of oil around the world could lead to higher gas prices at the pump, as well as higher costs of goods, which could take our already alarming inflation rate and bring it to cataclysmic levels. Now, specifically, there's a large network of oil pipelines that run from Russia through the Ukraine into Europe. So any conflict in the Ukraine could lead to a shortage or a stop in that pipeline network, which could then lead to a big shortage in gas and oil for a lot of the European nations. Fears of a looming Russian invasion have led the price of a barrel of crude oil up to almost $93 a barrel. That is the highest we have seen since 2014. And as of now, the average cost of a gallon of gas here in the United States is already up to almost $3.50. Once again, the highest in 8 years. So what does this mean to your portfolio? Well, obviously we've already been in a bit of a downturn here, with the S&P 500 going down past correction territory of a 10% drop. But if you look at previous S&P 500 returns during and after other geopolitical events, the S&P 500 usually takes these sorts of events in stride. After a geopolitical event like this, the S&P 500 drops on average about 4.6%. in the span of 20 days. After hitting a bottom, it takes an average of 43 days to retrace back to those high levels. So basically, geopolitical events like this disrupt the S&P for about 2 months. This is not to say that all events like this are the same. There's certainly a difference between now and the 2014 annexation of Crimea. There's also a big difference between something like this and 9/11 or Pearl Harbor. Plus, you add in the interest rate situation with interest rates set to rise, as well as our inflation situation with 40-year high inflation levels. We have a lot of uncertainty in front of us right now, for sure. And short term, the market could and probably will be very volatile. As we all know, the stock market does not like uncertainty, and right now we have plenty of it. But if you are a long-term investor like I am, history shows that this may be a good buying opportunity. I think you're going to have to be ready to do some buying here, unless you think that this event is going to be like a World War III level type of event. And I think that's what the markets are pricing in right now. Frankly, I don't think it's that sort of event. And even if it is that shit hits the fan scenario, I promise you the last thing on either of our minds will be our investment portfolio. We will have major other problems to worry about. So given the data on how the stock market rebounds during and after geopolitical events like this, I think it's a wise strategy, the most wise strategy, and the strategy that I'm using currently is the dollar cost average during times like this. I'm simply gonna dollar cost average, buy at certain intervals every 2 weeks or so, even as the stock market goes down, because you'll never know when the bottom is gonna be. But the good news is it won't matter, because if you're a long-term investor, in the long term, stocks will rebound and will get back to all-time high levels eventually. After the last couple years of insane bull market runs, I don't think we're gonna see the same thing the next couple of years, obviously. So we're gonna have to start thinking a little bit more long term, longer than 2 years. You have to look at 5 to 10 years at least strategy when you're putting money into the market. When you put money into the market, that's money that you should not have to have access to for the next, I would say, at least 5, if not 10 years. So as always, I will be dollar cost averaging into my favorite broad S&P 500 or total stock market index funds like VOO or VTI. I believe that as long as you are well diversified, which any S&P 500 index fund would clearly be, that even though a geopolitical event like this is scary, it should not concern you in the broader terms of your stock market portfolio. And it really shouldn't be anything other than a buying the dip opportunity for you. And if it's more than that, God help us all. That is it for today, guys. Thank you so much for watching. If you want to learn more about what we do on this channel, we talk about stock market investing, real estate investing, just general entrepreneurship, passive income, everything like that. Please consider subscribing. Would really appreciate it. It helps me to grow the channel. Also, hit that notification bell to stay up to date every time we put a video up. Until next time, guys, appreciate you watching.